If you are willing to stake your house for a line of credit, then do yourself a favor and watch this thing all the way through to the end. Welcome to the channel. I'm Peter with the Clear Close, the mortgage experts that help you get clear to close on your next mortgage. And today we're going to go over 11 mistakes that people make with their HELOCs. Before we move on, we do need to cover the basics of a HELOC. For those of you who are just joining us for the first time, if you've been rocking with us for a while, you probably have already heard this before, and you can use the timeline to just skip forward. We do have other videos on this channel that cover the structures of a HELOC more in depth and in detail, so be sure to go check those out as well. Really quick, in 60 seconds or less, let me break down what a HELOC is. A HELOC is a secured revolving line of credit, and it's secured by your home. That means you're using your home as collateral in order to borrow money. It functions similar to a credit card, but it's not, because it's backed by your house, and you get a much better rate because you have a hard asset securing that line of credit, as opposed to an unsecured line like a credit card or a personal loan. The line limit is calculated by using your equity position in the home and your ability to repay. You can get a variable interest rate or a fixed rate interest rate HELOC, and there are slight differences, but generally speaking, they both have the same structure. There is a window of time where you could use that line of credit, and there's a window of time where you can no longer draw money and you're just repaying the loan. Now, the rates are tied to a benchmark. Usually it's like the prime rate, and lenders will usually attach a small percentage point on top of that, plus fees that are used to pay the teams of people, including someone like me, the originator, to get you that loan across the finish line. And if you're like me and you've always wondered, why does it cost me money to pull out equity from my own home? Well, that's not really the right way to think about it. You're not technically extracting value from your home. There's not a pile of cash lining the walls of your banana stand.
Always money in the banana stand.
You still get to live in it. You hold title. It's your house, but you are borrowing money based off your equity position in the home. When you're borrowing money, you're essentially buying time. The time it would have taken you to save up that same amount from your 9 to 5 job or from your assets that you're holding to appreciate in value over X amount of years. Now that we've covered the basics of a HELOC, we can move on to the mistakes that people make and how you can avoid them. All right, now let's go over the top mistakes that homeowners make with the HELOCs and how you can avoid them. Number one, making major purchases on your credit cards just before closing. And this is a famous example that even real estate agents, when they hear about this, they just face palm, right? Because this is like one of the simplest things to avoid. If you're in the middle of closing a loan, don't do anything that would negatively affect your credit score or your debt to income ratio. If you buy that couch or that refrigerator or that washing machine in anticipation for this loan closing, hey, I'm about to have this huge lump sum of cash, right? And I'm using it for renovations. So I'm just gonna go ahead and pre-purchase these items because I know my loan originator said we're right about to close and I'm about to get those documents. So, honey, go ahead, buy that refrigerator. And it goes on the credit card. Before the loan closes, they're going to do a final check on your DTI or your credit score. They're doing a hard pull and um, yeah, now you don't qualify. So don't do that. Don't do that when you're doing a loan. Don't do that with any kind of mortgage for that matter, whether it's a purchase loan, whether it's a second mortgage or a cash out refi or a HELOC. It doesn't matter. Just have a little bit of patience. Wait till you get the money in your bank account or you have those closing documents before pulling the trigger and buying those appliances on finance or credit. The next mistake is pulling out too much equity. Just because you qualify for, let's say, $400,000 worth of HELOC funds doesn't necessarily mean you should pull out all that much. Let me explain. Context is very important here. If you don't have a plan for those funds, like what are you going to do with a 400,000 line of credit? That is a huge temptation to just spend on frivolous things or go on that vacation or buy new toys like a car. So remember, the context is really important here. If you do qualify for a large sum of money and you don't really have a plan for the funds, I would consider, taking a step back, pausing for a minute and thinking about it. Why do you want to have access to this cash? Because you are putting your house on the line. Are you planning an extravagant vacation? Are you trying to buy a car? Are you trying to put a down payment on a second house? Fix up your kitchen and bathrooms? Like, what is it? What is the plan? Let's talk. Schedule a call with the Clear Close, and we'll let you know if your plan is a sound plan that would really make good use of a HELOC. Because we want to make sure that you guys are not going to put yourselves into a hole that you can't dig yourselves out of. The next mistake is not borrowing enough. I just said don't pull out too much equity, but context is important. HELOCs are unique in the sense that you can like set a line limit and draw up to that limit. Like, let's say you have a project and your contractor gives you an estimate and he says it's going to cost you $50,000 to renovate your bathroom. Great. But if you've ever done any construction or if you've ever done any renovation or talked to anyone who's done home renovation, you know it's always going to go over budget. So you need to give yourself a cash cushion or a cash buffer. So whether that's a 10, 15, 20%, in some cases, you may even want to go up to like 50 to 100%. And just to illustrate this point, Nikki's here to tell you guys a story about this very scenario.
One of the biggest mistakes that many people encounter during a HELOC is to not take enough as a HELOC limit. For example, I had a gentleman that he's an elderly gentleman, so he's more conservative in terms of how he wants to take cash out of the value of his property. He and his wife really wants to do a renovation on their property, and it's the right time. They have a contractor, an amazing contractor that they got a quote from, and they needed about 110,000. 110,000 for them to renovate the kitchen and also to touch up on all the little things around their house. So we went about and qualified on the HELOC, but he actually qualified at the time for about 180,000 on the HELOC limit. So the HELOC limit is very different from the HELOC balance. If you don't use up to the limit, you're never charged principal and interest up to that limit. So, but him being very conservative, he didn't want to take the maximum amount. I advised him to basically, like, if you qualify right now at the 180, definitely just take it up to the 180. Just basically have the HELOC limit set at 180. But he chose to just take it up to 110. So he called me 7 months later and he needed 20 more $1,000. But unfortunately, at that time, I was not able to qualify him anymore. Now, here's the thing. When it comes to just 20,000, it doesn't mean that you pick up the phone and ask the lender to just give 20 more thousand. Credit income value all has to be requalified all over again just because of that 20,000. So he uses credit cards to supplement what he needed for the renovation. And now he's still short 20. And unfortunately, credit got shot at that time, as well as he already have a second lien. For us to do a third just for 20, now the equity position has to be dropped to 70% max. And at that, he was already over the 70% mark. So unfortunately, I wasn't able to get him the 20,000 that he needed. And that's a big lesson because just like, you never know if your credit's going to be pristine, same as what it was 6 months ago. You don't know if your equity position's going to stay at what 6 months ago. A really good example is, let's just think of it as in a dinner party, right? You want to have enough food. You want to have leftovers. You don't want your guests to have just enough food, right? What if two guests comes along and now you don't have enough food for everybody? How embarrassing that would be, right? But it's more so when it comes to dealing with money, right? With your own money, with your own financials, it's a lot more stressful of a situation and also would put you into a bind. If you were able to take out the HELOC at the higher amount, set the HELOC limit at the higher amount. And if you never use it, you would never have to pay back at that higher amount.
The next one is not having an exit strategy. Obviously, the way to exit any loan is to just repay it back, right? There's usually an amortization schedule, especially if you're in a fixed rate HELOC, there's going to be a set schedule of payments and it's going to be the same month to month. If you're in a variable interest rate HELOC, usually those come with interest only for the draw period. And the big problem with those is when you get to the end of the draw period and you get into the repayment period, usually it's structured like 5 or 10 years a draw. And then if it's a 30-year HELOC, the rest of it, like 15 or 20 years, is going to be the repayment. Whatever you've borrowed up to that time, it gets amortized into that shorter amount of time, that repayment period. So if you have a 30-year HELOC and it's fully amortized, fixed rate, and you draw on day one, you're going to be paying that over 30 years. The monthly payment's going to be much smaller. But if you're doing a variable interest rate and you borrow the same amount on day one, yeah, for 5 years to 10 years, that draw period, you're only paying interest, which is great. But when you get to that repayment period, your payment's going to skyrocket. And you might not be ready for that. So if you don't have an exit strategy, whether you use a fixed rate or a variable interest rate, know what you're going to be doing 5, 10, 15, 20, 30 years later. Whether you're refinancing, whether you're going to sell the house to pay back the loan, whether you're using it for your business as a stopgap for cash flow purposes, whatever it is, let's talk about a strategy where you're not going to be putting yourself into a difficult position 5, 10, 15 years later, and you regret making this decision. And we're in a really unique time right now. As of this recording, October of 2025, we're looking at several more rate cuts potentially from the Fed, right? So the Federal Reserve. And if they start to cut rates, that's going to affect prime. And a lot of HELOCs are tied to the prime rate. So if you do want to go variable and you foresee, interest rates falling, and that's your call. We talk about our fixed rate HELOC a lot on this channel, and that was really good for a high interest rate environment or interest rate environment that was climbing. But we're kind of seeing the opposite now, where interest rates might be falling. So it might be a time where a variable interest rate HELOC is something to look at. Another mistake that people make is not asking your mortgage originator the right type of questions or enough questions. Our job as originators is to look out for your best interest, you as the borrower. But we only know what we know. We can't see into the future. We don't know what choices that you may make in the future or what plans you might have unless you literally tell us, right? So, do yourself a favor, ask a bunch of questions. Like we can even do simulations like, hey, if I do X, what will happen to my payments? If I do Y, will I have any prepayment penalties? Or it shouldn't just be about the cost of the loan right now or overall in the perfect scenario. Let's stress test this a little bit. You want to know exactly what you're getting yourself into when you're doing a HELOC. And I would say this applies to any type of contract that you're signing. The next one is applying with a qualifying credit score. Yes, you heard me correctly. You used to need a 640 FICO score to qualify, but some lenders have actually dropped that requirement to 600, which is great. But here's the thing. If you have a 600 and you qualify, you're not going to get the best pricing. There's a little bit of a balancing tightrope here because if you need this HELOC in order to consolidate your debt and you've worked your way up to 600 or 640 or whatever it is, and you qualify, it might be in your best interest to just go ahead and do it and refinance it later when you do qualify for a better rate. But if you're not in a dire situation where you need this HELOC funds now, it might be better for you to boost your credit score a little bit, get it up to in the 700 range. That's where you're going to get the best pricing. And there's actually a lot of really good tips online, and we've compiled some of the best tips for you in a couple videos that we've made on this channel. There should be a card somewhere floating around on the screen. Stick with me, guys. We're almost through this list. I promise you that these next few are going to be worth your time. The next mistake is an inverse of the previous mistake. It's waiting too long to get a HELOC. I know. But context really matters, okay? So depending on your situation, you may want to jump and get this HELOC ASAP before you're unable to. All right. And to illustrate this point, Jason's going to be hopping on and telling you guys a story about a case he had with a client that unfortunately didn't work out too well.
I had a couple apply for a HELOC and they were right on the edge with credit. Not perfect, but we had a path. And then about halfway through that process, tragedy struck and one spouse passed away. Like what looked like a tough but possible approval turned into a denial. And with only one income, they no longer qualified. Like life hits hard. And because timing was off, they lost the option. And I believe they eventually had to sell their home because it wasn't sustainable on one income. So the takeaway here is simple. Don't wait. The question isn't, do I need a HELOC today? It's, do I qualify today? Because when life happens, and it will, waiting leaves you scrambling. And most people in that situation end up leaning on credit cards, selling stock, or pulling from investment accounts. And that's expensive debt. That's extra taxes and money that could have stayed invested and working for them. Instead, a fixed rate HELOC gives you flexibility. It's, if you don't need it, great. If something changes, you've got it ready. So the moral here, or the story, is don't wait for life to decide your options. Find out if you qualify now. If you don't, at least you know what you need to work on. That's why we share those credit tips in these other videos here. So you can be ready before life forces your hand. If you've got equity, decent credit, and a plan, hit the link in the notes. We'll run the exact numbers for your scenario and let you know where you stand. Because the worst case scenario isn't getting told no today. The worst case is getting told no when you need it the most.
The next mistake is mixing personal and investment use. I kind of alluded to this earlier, but a lot of people use HELOCs for their actual businesses, whether, for like cash flow purposes, because the business might have a lot of seasonality to it. A lot of people who get HELOCs also are just straight up real estate investors, right? They buy second, third, fourth, fifth properties. Maybe they have a portfolio of properties and they use a HELOC and they use a method called the BRRRR, the BRRR, buy, rehab, rent, refinance, repeat. Yeah, they use this method to continually buy, renovate, rent out, and then pull equity, do it again and again and again and again. This is really popular like before the pandemic, when house prices were relative to now, more affordable and rates were really cheap. Um, but that doesn't mean that this method has gone away. You just have to work harder to find those deals. But the mistake that a lot of people make is mixing or commingling, that's a big word, those personal use funds and those investment use funds. And most HELOCs out there, they're not going to restrict you on what you can use that money for. Sure, you might get benefits for using it on certain things, but essentially it is your money that you can use whatever you want. That's the beauty and the flexibility of a HELOC. But that just means it's up to you to separate whether you're using that fund for personal or investment. If you get a HELOC and you're going to use it 100% for investment, then just stick with that. If you're going to get a HELOC for personal, okay, you can do that, but like be nice to your CPA. He's gonna want your receipts, and if you're gonna use if you're gonna use it for tax write-offs, then make sure you're keeping track of all the things that you're spending. And I get it. If you're a small business owner, I know what you guys are thinking. Like Jason and I are both sons of entrepreneurs. Like we get it. All right. But the risk of losing track at the end of the year when you're submitting all your receipts to your CPA, it's not really worth it in my opinion. Like, hey, where's the receipt for this new dishwasher that you bought for your landscaping business? Right? Like, come on, man. IRS is not stupid, right? Like, they're gonna ask questions. So yeah, just keep a clear line. Don't mix personal investment use together. The next mistake is getting your HELOC at a big box bank like Bank of America or Chase or Citibank. Um, those guys sitting behind the counter trying to sell you the HELOC. I don't know if you know this, but like they don't have to be licensed. They don't have to go through the trainings that we go through, the ethics training, the RESPA, the truth and lending. Like they don't have to do any of that. And I guess you can just trust that those huge banks have your best interest in mind, right? Like all right. And I don't know where you are in terms of how much you believe in capitalism or not, but just know that brokers and mortgage originators like us at the Clear Close, we are mandated by the government, the federal government, to have the borrower's best interest in mind. Whether that means getting you guys the best pricing, right? Like we're brokers, so we have access to like hundreds of lenders, so we can shop around for you. We have to make sure that whatever deal we do for you, it's for your net benefit. And you might be coming to us for a HELOC, but after we get talking, maybe HELOC is not the best option for you. Maybe you need a DSCR loan, if you're an investor, or there's a bunch of different products out there like non-qualified mortgage loans that may help you achieve the goal that you need. And you're not going to get that at a big box bank. You're going to get that from people like us, the clear close. All right. The next one is, let's not forget about taxes. All right. Everyone forgets about taxes until it's tax season. So you may have heard that HELOCs can have some sort of tax benefits, but it really depends on what you use it for. There are going to be some use cases where you can include it in your write offs, but there are going to be some cases where you can, obviously, like personal expenses. So, talk to your CPA, talk to your tax professional. We are not tax professionals or CPAs, so definitely you need to talk with your people about that. But tax exemptions and tax write offs do exist when you use a HELOC for certain activities. We've talked about this in other parts of this video, but essentially don't count your chickens before they hatch, okay? All right, that was 10 mistakes that people make for their HELOC, but we have one more. We have a bonus one. Thank you for sticking around all the way up to here. And this one is maybe by far the most important. The final mistake that people make is not being well positioned to get a HELOC. What I mean by this is if you're not financially disciplined, then consider pumping the brakes for a second. Like, let's say you do qualify for the HELOC, like you make a lot of money and you buy a lot of stuff. So you want to take out a HELOC and borrow money to buy more stuff. Um, I don't know if that's the best thing for you, right? Like maybe you need to reduce your spending first and then get a little tighter control on that instead of borrowing money, or do something else to earn more money. Might sound more difficult, but in the long run, putting yourself into more debt to buy more stuff isn't really sustainable. Now, if you are a position where you do need a HELOC to consolidate debts, I think that's a great way to utilize a HELOC. It's on the other side of the spectrum, so there's the investor and then there's a person who wants to consolidate their debts. And HELOC can be a solution to both of those. So like if you are the person that wants to consolidate debt and you can qualify right now, a HELOC is an amazing option for you because I can almost guarantee that the rate that you get from a HELOC is going to be way better than the high interest credit card or even that high interest personal loan that you've gotten. And overall, that's going to give you a chance to get your feet back under you and retake possession and retake control of your finances and just be able to better manage yourself. And as long as you're committed to financial discipline, then you should definitely do this. So for people on both sides of that spectrum, whether you're an investor, whether you're trying to get out of high interest debt, I think the question that you need to ask yourself before you get a HELOC in order to avoid this mistake is, will getting this HELOC put me in a better financial position than I am in right now? And if that answer is no, then then don't do it, right? But if the answer is yes, let's schedule a call. We'll guide you to the right path, whether it's a HELOC, whether it's a cash out refi, whether if it's a DSCR loan. We have the products that can help you as a homeowner to achieve whatever financial goals that you have. As long as you qualify, and there's always that caveat. You have to qualify for these things. It's not free money. And if you've made it all the way to this part of the video, thank you so much. You guys get a thumbs up as well. Let us know in the comments what you guys want to hear next, whether that's like a different mortgage product, or some people have even asked us to put a course out, which is going to be basically everything that we have been talking about on this channel, but like in a more organized, like one-stop shop type of deal where it's like a PDF or one video, something we are willing to put in the effort to provide that value for you guys. I just want to see like a thumbs up on this video, please. Just so we know we're not putting something out and it's not going to go anywhere. All right. So please like, subscribe, and do the comment stuff. And we will see you guys on the next one. Bye-bye. Thanks for watching. If you're interested in learning more about a HELOC, we made a video for you and you can click that button on top. Or if you've been recently denied for a mortgage due to low credit, we did a series of credit boosting tips here on this bottom video.